So once again, welcome back to the study guide for the test, for your very first test. So I'm going to go ahead and go quickly review chapter 4 real quick and let you know specific areas that I want you to focus more on. Okay, especially for the accounting cycle. Now, if we mention what the accounting cycle is, you should know the definition, right? It's when you are planning to go through the process of series of procedures to ensure the accuracy of your accounting through collecting, analyzing, processing, again, the business transactions. Okay. So once again, this is a very important. Make sure that you do know the four characteristics of financial statements. So why do we produce it? As you guys remember from chapter 1, we produce it for two people, right? We would do it for the internal users, and we do it for the external users. Internal users are anybody that are inside the company. Of course, you want to work for a company that's making money, right? And you want to know if they have money to be able to pay you, right? You don't want to work for a company that you don't know anything about, right? And then, of course, for your external users, right? External users could be anybody that's outside of your company, and most geared towards people who are interested in investing or want to become a potential partner, etc., etc. Okay? So that is going to be why these four characteristics are going to be in place, because the sources, right? If we're collecting our documents, you want to make sure that the financial statements are reliable, right? Because you have proof to back it up. You want to make sure it's relevant within the given time period, because we have the idea where money changes over time. You definitely don't want to put a transaction that happened 10 years ago versus a transaction that happened now. You want to kind of be relevant, especially with the different methods that are coming out. You want to make sure that you keep up with the methods and make sure that the transactions are relevant in this prospective time period, okay? Consistent meaning using one type of method and sticking with it throughout the entire course of producing the financial statements. Consistency shows more accurate reports, because if you want to do profitability and you change from cash to accrual basis every time you go through it, you're not going to get an accurate measurement, maybe because you don't have a solid standpoint, right? Every month that you do, or every given accounting period, right? If you use an inconsistency, you're going to have numbers that can't formulate a nice graph to show you like a smooth transition or a nice depiction of how your company is progressing. So in this case, consistency, sticking with one method and using it throughout the entire time of your business. Okay. And then, of course, comparable. You want to make sure that your financial statements are comparable to other businesses out there, okay, that are typically in the same industry as you. Okay? Once again, so for this class, as I've mentioned before, we will, at the end of the 15 weeks, get to go from steps 1 all the way to step 10. So far in this class, we've only are practicing steps 1 through 3, okay? We won't take a look at the general ledger until we dive into the fictitious business. So steps 4 through 10 are going to be something that's going to happen in about 6 more weeks from now, okay? So in this case, what I want you to get out of this is just to be able to memorize the total steps and know what they are in order, because it's important that you know them in order. All right, because it's a set of procedures, right? Procedures, you have to do it in order, okay? Or else you're not going to be able to, complete the accounting cycle if you go out of order. You can't close your books if you haven't even recorded your journals in the first place, okay? You can't run a trial balance if you didn't first off journalize or post to the ledger. Because in order to create the trial balances, you need the ledger. And in order to complete the ledger, you need to complete the journal. So it's important that you understand the exact order of how the accounting cycle works, okay? So in this class, I just need you to know the 10 steps and the exact order, which in this case, right, I give you a review sheet that gives you all 10 steps right there, okay? So again, we are going to practice looking at a transaction and determining if a transaction has even occurred. And of course, we would do that by collecting the source documents to verify that a transaction has even occurred. So in this case, right, any receipts, any contracts, any invoices, bills, etc., those are going to be proof that a transaction has occurred. Then, second step is to analyze the source document and sort them upon the data that you're given, right? In this case, we're going to ask the when, the what, and the how, okay? The why is pretty straightforward, right? Why do you need to do this business transaction? It's pretty straightforward, right? I ran out of office supplies, that's why I need to buy them. So here we look at the receipt. The receipt or the source document should give you enough details to answer the what, the when, and the how, right? When did the transaction happen? It's dated, okay? The date's printed on there, okay? What happened? Well, it looks like I bought office supplies, okay? So I went to the store and I actually purchased office supplies. So that's what happened. How did it happen? Okay, or I guess in this case, how did you pay? Well, let's take a look. First off, we need to determine how much. In this case, my total office supplies was $61.09. How did I pay for it? I paid for it with cash. All right. So with that piece of information, we're able to get away. Okay, I bought office supplies and I used cash to get it. So therefore, now we can use transaction analysis, right, to journalize it. Okay, I bought office supplies for $61.09 and I'm going to journalize it exactly like this, okay? And that's all that we're looking at for the next 5 weeks. We're going to practice journalizing, okay? Journal, because once we become good at journalizing, that's where we can piece it together and apply it to our class project and see what happens when we try to set up our own business. What are the transactions that we need to take in order to go ahead and proceed with the business transactions? So in this case, here, step 3 is all that you're going to know up to, all right? Step 4, right, we're going to take the journal, right, and we're going to post it to our ledger so we know how much we have, giving a running balance for each individual account. So again, in my office supplies account, I never bought office supplies, so that means I have a balance of $61.09. Where my cash, right, I'm constantly purchasing, I'm constantly spending, I'm constantly adding money in there. So in this case, I started out with $2,000 because I made that $61.09 transaction. Now I have $19.38.91 left in my bank account. Okay, pretty relative, pretty straightforward, and we'll get more into this when we dive into the fictitious business. Okay. Again, steps 5, 6, 7, and 8. You don't need to know the true details of it until we dive into chapter 13 where we actually close out our book. So in this case, you guys can skip all this part right here because you will not need to know how to do it. But it is important, at least for this part, because you did learn about the financial statements in chapter 1. When you do finally reach that step to complete the financial statements, it is important that you know that what each financial statement does and why you create these reports, okay? So the first one is the income statement, or also known as profit and loss, okay? You're going to determine, right, did all the total revenues or the generated income that I've earned for the company, did it cover all of the costs that it took me to run my business? And if I get a positive number, then yes, you did good. You you made more money than what you spent. Okay? And then again, once we get this number here, this net income or net loss, then you have the choice to reinvest it into your company, which then the statement of equity comes into play, right? We're going to start with our beginning balance. We're going to add any net income or subtract any net losses because, again, that's reinvesting money into the company. Okay? And then here I have a positive number. Okay, and anything other than that, like such as withdrawals or capital contributions, right? Did I invest my own money in there, or did I take money away? Will affect equity. And once you've done that, right, then you're gonna solve for it. If I reinvested $300 into my company, then therefore my new equity should be $309 more than what I started out with. Okay, so this is the value of your company. Once we do that, then we test the balance sheet, which is testing the accounting equation. Does my asset equal my total liabilities plus my equity? The equity, which we solved from the statement of equity. Okay, so everything's gonna start piecing together and plugging things in together. Here, we're taking a look at a standpoint of how much cash is actually flowing into my company. All right, and we would determine that by taking the net income, subtract any accounts receivable because that's money you never received, and so on and so forth, right? It's split into 3 activities, which is your operating, investing, and financing. Once again, we won't go into too much detail until chapter 13, which is going to be, I believe, the 13th week of class, okay, when we finally close up our books. Then you're going to close out your temporary accounts, which is to zero out all of your revenues and your expenses. And what we're going to do is we're going to place that into income summary. Then that income summary is going to be placed into equity or close out to equity. Right? And of course, because we have to do another journal in between, we need to run our last trial balance, which is the post-closing trial balance, to ensure that this is the next piece of information that we're going to carry over to the next accounting period. Okay? So what is an accounting period, right? We talked about the definition, which is to complete the accounting cycle. All right? And examples will be, well, do I want to complete the accounting cycle every day, every week, every month, every quarterly, or every year? Okay, and in this case, right, when we talk about this is that when we decide to complete the accounting cycle, right, I will show you how long it will take to complete the accounting cycle. And I can tell you this, it is not very easy. It takes, like again, I'm dedicating 5 weeks to the class project, okay? And therefore, one of those weeks is going to be for the whole closing process. So think about it. 1 whole month to complete the accounting cycle can be extremely labor intensive, okay? And of course, it's going to be determined based on also, every year you have to file to taxes. So in this case, when you do create your accounting period, right, you also want to kind of go gear towards what kind of way to be able to gather in the information and to be able to submit it to the government. So you'll have the option to choose between calendar and fiscal year, okay? Because you file taxes every year. So you want to try to make sure that you pick one that makes it easier for you to file taxes. So again, calendar years from January 1st to December 31st. Where fiscal year is any 12 consecutive months starting on the first day of the first month all the way to the last day of the 12th month, okay? And again, it's going to be based on what your company does and which seasons are the busiest versus less busy, okay? And then we talked about accounting, generally accepted accounting principles. I don't care for you to guys know who create the rules. I just care that you know what the rules are, right? Because every rule, right, is determined based on what makes sense for trying to make everybody conform to an easy way to produce financial statements to make it consistent for all businesses. So hence consistency. So this is a way that the government can kind of regulate how financial reporting works. And of course, GAAP is going to be the guidelines, of course, of how accounting should be done. Again, you don't need to know who FASB is or ISB is. I'm not going to test you on that. Okay. I am going to test you on the 4 assumptions here. Okay. You need to know what the first assumption is, the business or economic assumption, right? Which we understand it to be as pretty straightforward. Making a defined line or decision between a business transaction and a personal transaction, right? If you're buying coffee for yourself every morning because you need to wake up, that is a personal transaction, okay? But if you're buying coffee for a business meeting, that is a business transaction, okay? Things like that, all right? We also talked about the going concern, which pretty straightforward, just basically says even though you have a foreseen foreclosure or something like that, you know something's going to happen to your business, you are going to continue doing business as usual. So if you know that your store is going to close, right? You are going to continue to execute all the sales until the day your doors close or till your bank account is closed out. All right, that's the idea here. You're going to continue doing business until the doors close. So in this case, I gave you an example for Sears. Monetary assumption. This one, I'm not going to test you on specific ones, but I just want you to be able to know the general idea here, right? Because the monetary assumption could be all 3, right? I just need you to be able to associate the difference between just the actual main ones, not the specific ones, okay? So I'm going to test you as monetary assumption as a whole versus the individual things. Now, what makes up the monetary assumption is going to be using some kind of monetary unit. Obviously, we live in the United States, then our type of currency is going to be the US dollar, right? Number 2 is going to be when we journalize, we're going to journalize in terms of dollar value, okay? Because that's how we measure a business transaction. How much did it cost you to run your business? If you say 3 days and 5 something, that's not going to tell me anything because you can, do a lot in one day or you can do less in one day. So in this case, right, my monetary measurement is going to be, you're going to record transactions in terms of dollar value, or in this case, as an overall cost. So I gave you the example of employees, right? If you have 20 employees, you're not going to write $20 in your 20 employees in your journal. You're going to implement it as a total cost of how much it's going to cost you to pay those 20 employees. Okay, and then of course stable currency in this kind of sense. Stable currency basically allows you to make projections in the future using some kind of stable currency, which in this case the US dollar, right? It's the most stable form of currency because in our sense, the dollar doesn't change that drastically over time, right? From a year from now, it's not going to be that different. But if you're talking about in projections of 10 years or 20 years from now or 100 years from now, then yes, you could definitely, include the idea of inflation. Okay. But in this case, you don't really need to know that one as much. It's not as prevalent as the other two. But just monetary assumption as an overall is what we're aiming for. And then, of course, the accounting period assumption is that when you are dealing with this, that the government allows you to break the accounting period into, months, quarterly, weekly, just so then you're able to make an accurate projection or to determine your profitability over a span of time. Okay, and that's pretty straightforward. All right. Next one I'm going to do is going to be testing you on basic principles. This one is going to be your go-to, okay? Because this one is where your journal is going to come into play, because these are the rules that are going to be tied directly towards to your journal, right? First one is historical cost. We always have to journalize our transactions at historical cost, especially when you make purchases of fixed assets, okay, or any assets in general, okay, because in this context, right, we're looking at if you purchase inventory, right, or if you purchase something, the idea here is that we don't care of what happens over time. We care more for about what the asset cost us right then and there, and how long it's going to take us to use the asset. So in this case, we cannot add value or we cannot decrease value to our assets at any given time. Only exception to this is, again, inventory, which we got to see, right? The lower cost of market, right? We can't assume that when we purchase our inventory, it's going to stay the same value. So in this context, but when we're looking at historical cost, you can't just miraculously say, oh, I bought a machine, right, for $5,000. In 10 years from now, it's going to be worth $20,000. No, that's not how accounting in the business world works, okay? In property management, yes, you buy a home for $50,000, 20 years from now, it's going to be worth $150,000, okay? That's different, right? Like I said, we mentioned before, property management or any type of realty kind of accounting is going to be super different. We understand equity as a value of the company, and it doesn't increase miraculously. You have to either add money to it or subtract money from it, okay? So same thing idea here is historical cost. We can't just add or recognize a gain over time. We must record at historical cost or fair market value the day that you purchase it, okay? Okay, next one's going to be revenue recognition, where this kind of it ties with the accrual basis, right? You recognize revenues when a task has been completed or when it has been earned, okay? So that is very key. So this goes along the lines with accrual basis, because we recognize revenues the instant it has been earned, regardless whether we received money or not. And that's the context here, is that when we earn our revenue, we must recognize it in our books, because that's one of the account types, right? We understand that when we want to record or understand profitability, we need to record and recognize our revenues the minute it happens, okay? Which then this is going to be directly correlated to the matching principle, because when we match, when we determine this, right, in order to match our revenues, it must stem from somewhere, right? So we would directly correlate it to the inventory items that we purchase, right, or whatever items that we use to create the service. In this case, when we match our revenues, it's going to match all expenses that it cost for you to generate that revenue. So that's the matching principle there, okay? And then last but not least, adequate disclosure is going to be pretty much if you need a place to put in any pertinent information that's regarding a transaction, but that you can't journalize, such as your 20 employees, right? I can write 20 employees in my books, but do I know what each employee does? No, I can save that for the notes of the financial statement saying, well, this guy's the president. this guy does this. This is why he's a salary-based earner, where everyone else on the floor are just, people who just run the shop, people who just run the cash register, people who just make the, coffee and go, all right? So that the notes of the financial statements is going to be any pertinent information that is involving a business transaction. There is an actual place for you to place it. And then, of course, I gave you many examples here. And then last but not least, these 4 here. I only want you guys to know the name. Okay? I don't want you to really know into too much detail because all of this is going to be dealing with managerial or cost accounting. In this case, we're only looking at finance accounting, right? Because what happens when you look through a profit manager or a cost manager, right? That's where you're going to weigh the cost against the benefits against the cost. That's where you're going to determine whether an item is significant enough for you to journalize because it may cost too much, right? This is where you need to determine whether when we sell a product, I'm going to be conservative, right? And of course, industry practices, right? When you're comparing to another company within the same industry as that's a profit manager's job, okay? So these 4, I will not test you on. So you don't need to know the details on this, but you just need to know that they do exist, okay? So, once again, I gave you some examples there. Cash versus accrual basis. We understand that cash versus accrual basis, we know it as, okay, when you choose to run your business as a cash basis, your idea is that cash needs to be present. If you're selling something, cash needs to be there. If you need to recognize the revenues the minute cash is received, and you recognize your expenses the minute cash is readily available for you to spend. Okay? If you don't have the cash, I'm not going to record the expense. Where in context, right, or an opposite, I guess, accrual basis says, well, I will record a revenue whether when I earned it or when the task is complete, the service is done, and my product is sold, regardless if I received money or not. Okay? Because in this kind of context, right, we're looking at, hey, I sold a product. What did you do? Right? I sold a product even though people owed me money. Now, in context, right, that's how business works because we're looking at how much you're selling, how much you're, profiting versus how much cash you actually really got from the company, okay, or from the customers, right? So in this context, right, we understand the accrual basis is going to be you recognize your revenues when it has been earned. So when a task has been completed, so our service has been completed, or when a product has been sold. Okay, you earned it. Okay, and expenses are going to be recognized when a task has been completed, or when you, for example, an expense, right? You hire somebody to remodel your store, right? When they send you the bill, that means the task has been done. They gave it to you, so that's the day you're going to record it, whether or not you paid or not. Okay? That's the idea there. Okay? And I believe that's it for this chapter here. So as far as that, if you want to read the example here, you have the example of to kind of understand what the difference between the cash and accrual basis is. But as far as that, here's the review. Once again, I gave you the list of all 10 steps here. Gives you context of the accounting period. It gives you the 4 characteristics of the accounting site. 4 characteristics of financial statements. Right? We talked about the generally accepted accounting principles. Right? I'm only going to test you on the first 8, not the last 4. Okay, I'm not going to test you on materiality, cost benefit, conservatism, or industry practice, because once again, we're looking at financial accounting, which doesn't really deal with this section. Okay, So again, if you need help to kind of memorize this, understand it as your ABCs, okay? Your assumptions, your basic principles, and your constraints, okay? So once again, you can print these out and make notes if you'd like. Okay? And of course, the difference between a cash and accrual basis. So let's go ahead and dive right into the questions, and then we'll ask questions afterwards. Okay. So question number 18 asks, which of the following belongs to the accounting cycle? Okay.
That's plural, right? Step. So.
Yeah. So your options is.
Report in general. I mean the record in general journal.
Mm-hmm.
The general ledger. Analyzing and sorting the data.
Mm-hmm.
Post adjustment entries.
Mm-hmm.
Financial statements.
Mm-hmm.
Closing the books. Closing the books.
Mm-hmm.
And prepare the trial balance.
Mm-hmm.
Did she say that one already?
Mm-hmm.
No. That should be it, right?
So the options are A, 1, 2, and 3 only, B, 4, 5, and 6 only, C, 7, 8, and 9, and 10 only, or all of the above.
I'll go with D.
It is all of the above. These are the exact 10 steps to the accounting cycle.
Where did I miss the prepare adjustment trial balance and prepare trial balance? But it's all of the above. It's all of the above. I missed that somewhere. I was asleep.
So here, let's see. Chapter 4. Okay, so you said which one? Prepare the trial balance. Step number 5. Okay, and what was the other one?
No, I got it because I see the whole list there. Never mind.
Okay. Question number 19. Okay, which of the following is not a characteristic of financial statements?
Reasonable?
Yes, right? It is definitely not reasonable. Right? It is definitely reliable and definitely relative, right? Or this relevant and consistent, yes. Number 20, under the rules of GAAP, okay, which rule states that personal assets should be separate from business assets? A, business or economic entity, right? It doesn't have to be just transaction in general. It's just making sure that you can divide and put a fine line between business and personal. Okay. Number 21. Okay. Under the rules of GAAP, which rule states that when recording a transaction, it should be recorded in terms of money or value?
Monetary assumption.
Monetary assumption. Okay. Question number 22, okay? Under the rules of GAAP, which rule states that when making a purchase of an asset, okay, they are recorded at original selling price, okay? The value does not change over time.
Historical cost.
That's correct. Okay, historical cost. Right? Question number 23, okay? Cash basis is when?
A and the B.
Say that again, B, A and B. Okay, so A says revenues are recognized when cash is received. Okay, that's correct. B says expenses are recorded when cash is readily available to spend. That is correct. So D is correct. Right? A and B are exactly what a cash basis does. Okay. Our last question here, number 24. Accrual basis is when?
C.
C, right? Expenses are recorded when incurred. All right. Excellent job, guys. Okay, so, all right, that's it. I'm going to stop here for today because tomorrow I'm just going to cover chapter 5 and chapter 6 with you guys. All right, other than that, if you guys have any other extra questions, you guys can stay and ask them. But if not, you guys are free.